Well, we've reached a point where the market has continued to go up and defy expectations. We have the S&P 500 up currently 10% year to date. Another 10% gain after a huge year last year. Then we have the QQQ up 9.6%. Stocks are going up. My portfolio also reached an all-time high today, now up to $200,000 in gains. And it's times like this where things feel expensive. It feels like there's not many deals in the market. It's more difficult to find stocks that are selling for cheap. But in this episode, we're going to take the challenge. We're going to go over 3 high quality stocks that are currently in a dip and go over the case for buying each one of them in this video. Now, we also have some bonus news. We have news that it looks like OpenAI just wants to get into more and more things. And we have this headline here that OpenAI is reportedly planning to compete directly with Google by launching their own search engine. So OpenAI has the LLM, and that was supposed to kind of be a competitor to Google. A lot of people are concerned about that. Now OpenAI is reportedly planning to announce a Google search competitor, a direct head-on competitor, Monday. We'll be talking about that. We also have news that Apple is apologizing for its iPad Pro ad showing a hydraulic press destroying guitars and pianos. We'll be talking about this news and the drama behind it. And then finally, is it a good thing when a CEO steps down from a company, has a new successor take over, but then continues to backseat drive, giving input and feedback for the new CEO? We'll be discussing this case in the case of Starbucks and showing the problems with Howard Schultz continuing to be a backseat driver. So we have all of that to cover. Let's go ahead and jump in. Now, if we start off by looking at my main portfolio here, we can see that the passive income account has reached an all-time high. Stocks are moving in the right direction. This one has been led this year by the restaurants. These 2 stocks have done the best in my portfolio year to date. Texas Roadhouse and Chipotle are both up huge. Chipotle has been a rocket. I bought the company just last year and it's already up almost double from where I bought it. Texas Roadhouse is not far behind. For a full service restaurant, this one has done incredibly well. So both of these have been leading the portfolio this year. Another one that's done incredibly well this year is Costco. This is one that it's just been a compounding machine since day one of buying it. It continues to compound. But nobody can say these stocks are cheap. Costco's at like a 45 PE ratio. Chipotle's at like a 50 PE ratio. Even Texas Roadhouse is getting to the more expensive side. There's other companies that have done a little bit, worse this year. They haven't performed this year. Vichi's one of them. This is my loser so far this year. It's still doing okay, but this one has been a bit weaker. Overall, when I look at my portfolio, most of the stocks are just doing really well. They're moving in the right direction. Even when we look at the story fund, if I switch over to that, we can take a look here at the story fund. And this one, again, is close to its all-time high, led by Amazon, Netflix, Google, and Microsoft, which are all doing really well so far. So when I'm looking at my portfolio, I don't have many companies in the red year to date. None that have really gone through a huge dip. And what I'm looking for are buying these type of companies. And I want to highlight 3 of them. These are 3 companies that I think are both very high quality, but are also going through a bit of a cool down or a sell-off this year. The first one is Adobe. And again, I hold no position in Adobe. So this isn't a stock I currently own, but the reason that I believe it's attractive right now is because it's a very high quality company that's currently selling down. It's down 17% year to date. So the market's going up, Adobe's going down, and a high quality company that starts to trade down this much eventually becomes very attractive. Now, I first want to go over a quick overview of what Adobe is, because a lot of you know about Adobe. At least you'll know that they make Photoshop and maybe Adobe Premiere. That's usually the extent of what people know, but they do a lot more than that. So let's go ahead and just take a quick look at what Adobe actually does. On Qualtrim, we can see the revenue and the incredible growth of the revenue since 2015. That is when Adobe transitioned from a one-time sales type of business model to a subscription business model. The subscription business model and the growth of the Adobe Creative Cloud and their other products made it so that their revenue grew rapidly. And we can see their products on a more granular basis by looking at the KPI of their revenue by segment. We broke it down here into 3 different categories. These are the 3 different main categories of Adobe's revenue. First of all, we have digital media. If we just look at this, you can see it growing over time steadily. Every single quarter. This is quarter by quarter growth. That's incredible. It's rare for a company to grow a line of revenue every 3 months, quarter over quarter consecutively for year after year after year. You have to have a fantastic product to do that. And the digital media portion of Adobe is fantastic. If we look at these different segments, like the digital media, digital experience, publishing, and advertising, I want to define what these actually are. We can look at it right here. This top portion is the digital media portion of revenue. So it's this orange part right here. That's what we're looking at. It includes the Adobe Creative Cloud, which is all of this stuff. Recognize all these thumbnails? You have Photoshop, Premiere, Illustrator, InDesign, After Effects, Substance 3D Stager. You have all these different painters, InCopy, character animation, Photoshop, Lightroom Classic, Dreamweaver, remember that? Premiere Rush, and then you get to the other big ones, which is Acrobat. And then Adobe's doing something different. They're also including a lot of new web applications that are AI applications. So one of the reasons I believe Adobe's trading down right now is investors can't make sense of whether or not Adobe's going to be helped by AI or hurt by AI. There's a lot of companies now doing AI image editing and video editing, and that seems like it's a threat to Adobe, which it potentially is, but a lot of those tools are using infringed copyright material. And if you run a business, you run the risk of getting sued if you use infringed material. Adobe has positioned itself to use only copyrighted, legal use material. So when you're using Adobe products and you're using their AI tools, you know that what's being generated is legal for your company to use. And that's a huge advantage they have, is that trust with different corporate customers. They're also developing things like Arrow or Firefly, Illustrator, beta in web application. So they're updating their applications to be on the web. They're going more modernization with them, and they have the team to be able to do this. But you can see the plethora of creative apps they have. They have everything. And I'll tell you that I use some of these apps. I constantly use Photoshop and Premiere every single day. Because I use Photoshop and Premiere every single day to edit my videos and edit my thumbnails, Adobe charged like $35 a month for it. And they recently raised the prices by $20. So it's like $55 to use the Adobe Creative Cloud. What did I do when they raised prices? I continued to pay it. I didn't want to switch over to a different application. I didn't want to relearn everything. I thought that $20 extra is worth it for my time to not have to relearn a new type of Photoshop or a different competitor to Adobe Premiere. So they have pricing power because people are already using their tools, and most people don't want to switch over when they've invested time to learn all of these tools. Now, they're also developing all these different things, all these mobile apps, all these web applications. They're pushing out and advancing in these territories. Since they weren't able to acquire Figma, I see them moving in the direction of competing directly with Figma. So this is all the Adobe Creative Cloud. All the different applications, all the web apps, all the mobile apps, all the collaborative tools, all of this type of creative stuff is included in the Adobe Creative Cloud subscription. They sell it as a subscription where it's like $50 a month. If you buy it for a company, you might be able to get a bulk license. It's a bit cheaper, but they have institutions using it, large companies using it. They have college campuses training students on how to use it. It's ubiquitous. It's like Spotify or Netflix. It's just everywhere in the world, people are using the Creative Cloud. And all of this is included in this first segment of revenue, the digital media. That includes the Adobe Creative Cloud. But that's not the only thing being included here. This also includes the document section of it. So we know companies like DocuSign or Box.com, where you can sign PDF documents. They're really important when you're doing legal contracts for sales teams. If you have someone show up and they want to sell you pest control, they want to sell you a contract for something, they want to sell you a solar system, they're going to have documents for you to sign. And they're going to be using a document cloud for you to sign those agreements. Those are usually done through companies like DocuSign, or in many cases, through Adobe's document cloud. Adobe has the PDF. They have all the signature tools, and they have a huge cloud business that does all of this. So this is something that customers don't deal with quite as often, but it's a huge segment of business. It's another big part of Adobe, and it's included in the digital media. So the documents, the Creative Cloud, all of that is this first line and most important line of revenue. And you can see this growing quickly year over year and quarter over quarter. Then we move on to digital experiences. This is a smaller portion of revenue. It's also growing quarter over quarter. It's growing very quickly. The Experience Cloud includes a lot of stuff that you're probably not quite as familiar with because most people don't use them as a customer directly. But there are some applications you'll have heard of. Adobe is a huge analytical business. So you have Adobe Analytics. They're the ones that give you all the online shopping trends because they know how many people are buying different things. You have Adobe Customer Journey Analytics, Adobe Real-Time CDP. You have content managers and commerce managers. You have customer journey applications, Adobe Target, Adobe Campaign, Adobe Journey Optimizer, Adobe Marketo Engage. They have a bunch of different tools that they sell under this Adobe Experience Cloud. So the second line of revenue, the digital experience, is the Adobe Experience Cloud. And then we get to the smallest one, which is publishing and advertising. This is the only one that's not growing. It's just flat. But luckily for Adobe, this is by far the smallest. If we look at these in comparison, the Adobe publishing and advertising, you can barely see. So even though this one isn't growing, I don't consider that a problem because it's a tiny form of revenue. And that is right here. This type of stuff at the very bottom, Captivate and Captivate Prime, Fontfolio, PostScript. This is a bunch of little add-ons and additions that they have in their suite of software. And I think that they just bucket this into a different place because it's not included in these two main lines of revenue. But really, if you're looking at Adobe, it's the Digital Experience Cloud and it's the Adobe Creative Cloud and their Document Cloud. Those are the biggest segments of the business, and they're also growing the fastest. So overall with Adobe, we have an incredibly robust business with multiple lines of revenue, most of it subscription-based with very high retention. And then on top of that, you look across the fundamentals and they're fantastic across the board. Consistently growing EBITDA, you have overall very strong free cash flow growth and free cash flow per share growth because they're buying back shares. You have a company that has a balance sheet with way more cash than they have debt, so they have a very strong balance sheet. They're not paying a dividend right now, but they are doing the buybacks, buying back a decent amount of shares, and this is accelerating as the share price drops. And like always, Adobe's a company that has incredibly high margins. So you look at the gross margins, 87%. That's well above Microsoft. That's 17% above Microsoft. You have operating margins of 34% and profit margins of 28%. It doesn't get much better than that. This is one of the best margin companies in the world. So you have a company here that's incredibly strong and it's selling off because of fears of AI competing with it. And while I agree those fears are real, I think in many cases, they're not going to manifest as strongly as people believe. I think Adobe's probably going to be fine, and they may even benefit from AI. When I look at the current valuation, it has a 26 forward PE. It has a 3% free cash flow yield. They have some stock-based comp, but they're getting that under control. And I think the stock is presenting an opportunity right now with it trading down 16%. The next high-quality stock on a dip is MSCI. This is another one that I don't have in my portfolio, so I'm not invested in it, but I find this stock intriguing. It is an indice business, like S&P Global controlling the S&P 500 and the Dow Jones. MSCI is one of the largest international indice businesses, and that's a very, very good business. So MSCI right now is an interesting one because it's down 12% year to date. So the rest of the market's going up, this one's going down, and it's a very high quality company. When you look at a company like this that's traded down over the past year and even over the past 5 years, since 2021, it's been down. It's never recovered since then. Eventually, with a great company that's growing, the fundamentals catch up to the price. And I think that's what could be happening here. If we look at this recently, the stock traded down a lot after earnings. It went from $515 down to $460. So it dropped big after earnings, and we can look at what happened. When they reported earnings, things were worse than expected. Their revenue didn't grow quite as well. Their free cash flow is a little bit lower. Some of the numbers were off. But the biggest number, the one that investors were the most concerned about, was the retention rate. The retention rate is how many customers they keep from month to month, and the retention rate went down dramatically quarter over quarter. Now, that doesn't seem like a lot because they're close together. They're both in the 90s. But when you're working with a lot of customers, even a 1% change in retention rate is pretty dramatic. It means that you're losing a lot more customers at that point. That's a pretty sizable drop in the quarter. And the estimates were way off. They thought the retention rate would hold steady. The retention rate is also dropping, if we zoom in here, just over the past couple of years. It went down from 96.4 all the way down to 92. So when it goes from 96 to 92, the retention rate is becoming kind of a red flag. Investors are concerned about it because this is a subscription business. There's companies that do business with MSCI. They subscribe to their products and services. That's how they make money. So this is a bit like Netflix losing subscribers, right? The retention rate goes down. You're losing customers and subscribers. And that is what caused the sell-off. That's what's causing the stock to, instead of racing up, it's going down right now. Now, there is good news with this quarter because what we want to do in these situations is differentiate between temporary challenges and long-term secular problems. And right now, I believe the decline in retention rate is temporary. It's not a long-term issue that's fundamental or systemic in the company. For example, if we look at the commentary from the CEO in this last call, he says, quote, "Elevated cancels reflected a concentration of unusual client events, including a large merger among our banking clients." So part of the cancellations here, a good portion of it from the CEO, is that simply there are some unusual corporate events. A lot of different companies had a huge merger. And because they had a merger, they could cut costs because they didn't have individual subscriptions. So that's a one-time event. They're not going to keep merging. That's something that happened one time and impacted their retention rate just this last quarter. He goes on to say, quote, "We are managing through these pressures and do not expect this level of cancels to continue." Directly from the CEO. And I know CEOs can say, they can say what they want, but I think they're mostly truthful. And at least with these statements, he has to have reason to be truthful with this type of projection. They do not expect this level of cancels to continue because what they're viewing here are that many of the cancellations in the first quarter of 2024 were due to corporate events, including closures of organizations, funds being shut down, and restructuring and downsizing. So this is lots of like M&A activity, restructuring of organizations, things that aren't long-term systemic problems. And furthermore, this shows that the reason that the retention rate is down is not because of something wrong with MSCI. It's not like their product got worse or the indice business is fundamentally doing worse. This is simply temporary issues this quarter. Now, you can believe that or not, but that's what I believe. I believe it's a temporary issue. And if that's the case, that means that next quarter and the quarter after, the retention rate will start bumping back up. If the retention rate starts bumping back up, I imagine the stock will get a new bit of life to it. I imagine investors will become a little bit more confident in the future. So MSCI is the number 2 business that I would highlight as a high quality compounder that's going through a temporary dip. Now, the third high quality company that's going through a bit of a downturn right now is UnitedHealth Group. If we look at this stock year to date, it's down 5%. So again, it's another one that's taken a breather. And if we even zoom out further, it's not down over the past year, but it's only up 5%. So it's a flat stock for an entire year, taken a bit of a breather. And this historically has been an incredibly high quality compounder. If we look at the past 5 years, it's up 113%. And you can see that it was steadily climbing for the first 4 years. And then the most recent year, it's just sat mostly flat. And that's what quality stocks do from time to time. They grow quickly, they'll have a rapid increase in stock price, and then they'll trade around flat for a couple of years. And in these time periods where the stock is trading around flat, some cases it's a good time to be accumulating a position in this company, especially if you can buy it at a discount, at a dip, like we find ourselves right now. Year to date, it's down 5.8%. It's trading currently at $511. Now, what does this company do? UnitedHealth Group is the largest insurance company in the US for healthcare, meaning that they basically are a requirement for most people. Most everyone in the US has health insurance. You really have to have it because if anything happens, it's so expensive. If you don't have health coverage, you're in trouble if you have some health problem and you don't have health insurance. So a lot of employers offer it. In fact, many of them are required to offer it, as well as they sell on the exchanges, and they have lots of different ways of offering their services. Now, one thing I look at with this company is I'm not the most knowledgeable about the insurance industry and healthcare. There are 2 different areas that I avoid, but there is one thing I know for certain. Healthcare in the US is great in terms of the knowledge of doctors, the equipment, the speed of treatment. I believe we have some of the best healthcare in the world when it comes to to the people that practice healthcare. I think that we do it really well here. We have very skilled doctors and nurses, very skilled surgeons. We get people in quick. We fix huge problems and we extend the lifespan of people. So that side of the healthcare industry, I think, is great. But then we get to the billing side of things where you have to pay for it. And that side is a complete disaster. The Western healthcare system, specifically in the US, paying for healthcare is a complete disaster. There's no transparency with the price people are paying. It's all very convoluted. You have to work through reimbursements, and it's all just really messy. I don't think anyone in this country is really happy with the payment and financial side of healthcare. That's where things get really, really bad. So I want to do a differentiation here. I think healthcare in the US is great in terms of the treatment. I think it's really bad in terms of the payment and financial side. And that's a side of things that I don't view getting better anytime soon. So when we look at that, we see this company growing in two ways. One way that it's growing is through the amount of patients it's caring for. This is people served by quarter. And it has two different segments. We have UnitedHealth Group. That's one of the companies that they operate. And you can see that this is mostly flat since 2017. This one hasn't moved too much. And then we get to Optum Healthcare. This one actually is growing over time. So you can see kind of a steady growth there over time. So they're slowly but surely increasing in the amount of people served per quarter. And I think that's important. More people served, bigger US population, more people need healthcare. But then they also primarily grow through inflated healthcare prices. Now, the way the insurance works is they're not really raising prices. It's more that everything else in the healthcare industry is getting more expensive, and they're covering for that. So as they get higher premiums, they have to raise prices, and they've been doing so around 15% per year. So looking at this company, it's another one that I think is taking a breather right now. It's not racing up like the rest of the market. So if you're looking for a stock that's super high quality, that's taking a breather, it's going down this year, I believe UnitedHealth Group is a good option. So that's the three companies that I think are high quality that are in a dip. Now let's go ahead and move on to some of our headline news. We just received news a day ago that OpenAI is intending to make a search engine competitor to Google. Let's go ahead and jump into this and just see how it's reported here.
OpenAI planning to announce its artificial intelligence-powered search product on Monday. That's according to a new report from Reuters saying that the announcement date is subject to change. OpenAI has been working on a search product that could potentially compete with Google and Perplexity. Release on Monday would front-run Google's annual I/O conference. So that's where a little bit of the speculation is coming from, where the tech giant expected to unveil a slew of AI-related products. Could they get ahead of them? We will see.
So there you have it. Not only did OpenAI announce that they're directly competing with Google, releasing a new search engine competitor this Monday, but they also just happened to announce it right before Google's I/O conference, which is like their developer conference. So Google's trying to get people excited about what they're doing, and OpenAI is like, nope, we're doing all this cool stuff, and we're going to front run your conference and try to get headlines. That's a very popular strategy for smaller companies. They wait for big companies to have big events, and they'll try to release all their stuff right before to kind of still the thunder. So this is a tactic by Sam Altman, and I want to go over what I think will happen, how I think this will play out. Let's go ahead and take a look at Google, which is one of my holdings. So I am invested in this company. We can take a look at Google search. We'll look at the revenue by different segments. We'll cross out YouTube and Google Network and subscriptions and Google Cloud and other bets. So we just have left search. This is the revenue that Google has made just with their search engine alone. You'll notice that generally speaking, it's going up over time. Now, what has happened over the past 2 years, right? This is like 2 or 3 years because this is on a quarterly basis and the revenue is going up consistently almost every single quarter. It's just edging more and more up. What's happened during this time period? Well, Microsoft decided to compete directly with Google, offering AI Bing. And they made a big fuss about this. They talked about how they're making, the gorilla in the room. They're making them dance, right? They're putting pressure on Google. Google was a little bit concerned about this. But again, this growth in revenue in search happened during Microsoft promoting their huge AI Bing search engine, doing everything they could to gin up excitement about it. And this is the outcome. Google search grew that entire time. Brad Gerstner went on to CNBC with a bearish take on Google, saying that he thought all the LLMs, OpenAI, ChatGPT, all these different LLMs would take market share from Google search. Again, during this time period. But we look at the fundamentals, we look at the actual data here, and what do you see? Google has been growing its search revenue this entire time. Now, you may say that's just an improvement in the ad revenue. Maybe they're actually losing market share, but they're just increasing the amount of ads. Maybe, but even looking at third-party analysis on their market share, they're not even losing market share. So Google so far, through all the competitors of Bing with AI search, ChatGPT, you have all these different LLMs at the same time, and this company grew revenue. So when I look at the threat of Sam Altman and OpenAI taking market share from Google search, personally, it does not concern me. I think the most likely outcome by far is when we look back at this exact chart, the Google search revenue 2 years from now, I think it's going to be higher than it is today. Now, next up we have news, and this is the headline. Apple apologizes for iPad Pro ad showing hydraulic press destroying guitars and piano. Now, you read this headline, and if you haven't seen the ad, you think that doesn't sound right. An iPad ad that shows a hydraulic press destroying guitars and pianos? Like, this has to be taken out of context, right? Something has to be wrong with this ad. Not really. We can take a look at a bit of the ad, and it's literally a hydraulic press just crushing different instruments. Beloved things that people love, that they have memories with, they have nostalgia with. Creative tools like guitars, pianos, everything is getting crushed, and it just gets crushed into obliteration. And then at the very end of it, they show an iPad. Now, of course, I get the symbolism of it. They're trying to show off how thin the iPad is and that it's a creative device. And basically that they're compressing all of these tools into a slim format, which is a good concept. I don't have any problem with the concept, but I think it should have been obvious for a company like Apple to know that the visual of crushing instruments that every creative person loves is not a great visual for an advertisement. It kind of has a dystopian feel to it. Like, it's just, hey, get rid of all that nostalgia, all the stuff you love. We have this new slim gray device that's going to replace all of it. As soon as I saw that ad, I knew it was a miss from Apple. They missed big on it. Now, I don't agree with them pulling the ad. I don't think they needed to do that. And it sets the precedent that they'll do whatever the mob wants. If the mob is angry online, Apple's going to bow to the mob. So I don't know if they should have done that. But I think there's a lot of ways Apple could have done this same concept, the same idea of taking all these instruments, putting it into the iPad. They could have done it better. They could have used a vacuum and just vacuumed all the instruments nicely into the iPad. But the visual specifically of all the instruments being slowly crushed was the problem, and that should have been obvious to Apple. Now, finally, we get to this news that certain CEOs that have picked out successors for themselves, they've trained them, and then they've stepped down from the company, seem like they don't really want to give up the CEO position. They want a backseat drive, which is always annoying. And in this case, in corporate America, backseat driver CEOs are even more annoying. If we look at the latest case of this, it's clearly the Starbucks CEO. We highlighted on this channel the completely dismal interview that the CEO of Starbucks did with Jim Cramer. He really just got unpilled in that interview. I mean, it was really bad. If you haven't seen it, go back and watch it. But after that happened, Schultz, the previous CEO, stepped in and he gave his opinion on Starbucks, and he did so on LinkedIn. Now, these relationships can be complicated. It's important that the previous CEO, the one handing the baton, instills confidence in their new successor, in their new pick. And this is how it started off. You have the new boss, Narasimhan, saying, there's only one boss, and that's me. So he's pointing to me, saying, I'm the leader now. And he says, basically, there'll be times where I'll have feedback from Schultz, the previous CEO, but I won't always agree with him, and we'll resolve those matters privately. So they're going to communicate, and Schultz is going to give advice, but he's going to do so privately. That lasted 1 year. After 1 year, all of this exploded into public view when Schultz wrote a LinkedIn post. So on LinkedIn, he writes like this 2-page post that's an open letter of shareholders criticizing how the new CEO is running the company. And he does so criticizing the new leadership right after a bad earnings report. So Starbucks is down 20%, and then Schultz comes in and says, look, this is how I would do everything, and things aren't going well with the culture. And he gives all of this unsolicited advice right after a bad earnings report. So Schultz basically waited until the successor stumbled and had one bad quarter where the stock went down 20%, and then he stepped in to just layer on criticisms after the new successor stumbled, saying, this is what I would do. I would not try to do everything at once. Leaders must be both humility and confidence, and they must work to restore trust and increase performance across the organization. Well, that's great advice, Schultz, but how do you instill confidence in your company that you're the right leader. One way that you don't do that is by having the previous CEO undercut you, undermine your ability to lead, and do so right after a bad quarter. In fact, that is the opposite of instilling confidence. Now, since Schultz did this, and because the post got 10,000 likes, millions of views, there's all different people watching this, it's humiliating to the new CEO. It is humiliating and it undercuts his ability to have confidence. And now there's executives and managers at Starbucks that don't really know who the real leader is. Is it still Schultz? Is he kind of guiding the company in a way? Or is it the new CEO? Who should we be taking advice from? Who's calling the shots here? It makes the whole situation very confusing for the company. So in his attempt to give advice, this open, critical advice, he hurts the company that he's actively trying to help. It's very similar to the situation with Disney. You had Bob Iger pick Bob Chapek as his successor. He handpicked him. He trained him. But as soon as he gave over the baton and said, you can become the CEO, he didn't really step away. He went to an executive chair position and he continued to give advice and input and criticism for the new leader, undercutting him and confusing different people at Disney of who is really the boss. And you saw how that ended with Disney. It never ends good. The situations where it does end good, the situations where the handoff is great, are companies like Netflix. Remember what happened when Reed Hastings stepped down from Netflix? The stock subsequently plummeted. It had the biggest drop it's ever experienced throughout its life right after the CEO handed the baton over to the co-CEOs. Reed Hastings steps out. But what does he do when the stock stumbles? Did he write big LinkedIn posts explaining what the current leadership is doing incorrectly? Did he make a big public fiasco about it? Did he try to undermine the current CEOs during this time period? Not at all. All his comments were very supportive. No criticisms. He had complete confidence in the leadership that he picked. And why wouldn't he? He's the one that picked them. Netflix has recovered fully since then. And the new leaders have full confidence from the company and the employees. Sentiment's incredibly good at Netflix because people respect the leaders of the company. The same thing can be said for Amazon. This is another counterexample of a company where as soon as Jeff Bezos stepped away, Amazon stock dropped dramatically. It went from $176 all the way down to $81. And what did Jeff Bezos do to Andy Jassy during this time period? Did he publicly embarrass Andy Jassy? Did he say that he's destroying the company that he loves and they need to change the culture and give all of this unsolicited advice? No, he didn't. Bezos said things were fine. He has complete confidence in Jassy. He talks with them and they bounce off ideas from time to time, but Jassy's the leader and Bezos had complete confidence in him. And why wouldn't he? Bezos picked Jassy. He's the one that he knew would lead the company in the right path. Had Jeff Bezos soured on Andy Jassy and turned on him and undermined him and criticized him and humiliated him, it would have made Andy Jassy's job 10 times harder to work on recovering Amazon. But since he had confidence instilled in him, now Andy Jassy has a very high degree of confidence from the company. So when I look at these type of examples and I see what Howard Schultz is doing right now, whether his intention is good or not, the outcome is bad. If he has criticisms for Starbucks or the new CEO, he should either give them privately or not give them at all. And if he wanted to be the CEO of Starbucks, he should have stayed the CEO. He, after all, chose to step down and retire. That's all for this episode. Hope you enjoyed. See you in the next one.